A lot of first-time home buyers think that buying a house is similar to buying a car in that you just find a house that you want, you find out what the payments are going to be, and then there's a person that can just get you the uh, mortgage right there on the spot as long as you have the down payment and the payments and your credit works. But the reality is getting a mortgage is a lot more complicated because there are a lot of laws around real estate that aren't the same as buying a car. For example, the title process, for example, the protections for homeowners, the anti-discriminatory laws, and on it goes. That's why it typically takes 20 to 30 days to get a full approval. Plus, you have appraisals, inspections. You've got a lot of moving parts. So in this video, I'm just going to talk very quickly and briefly about some of the key things that a lender is going to look at when they're determining if they're going to approve you for the loan. First, they're going to look at your credit report and credit history. In other words, that's your willingness to pay. It shows historically if you've been paying your payments on time, how much you've been borrowing, what your capacity is to borrow more, and so on. So the score is part of that picture, but it's also a matter of the debts, the payment history, the trended payment history, and so on. Next, they're going to look at your income, your ability to pay. For example, if you borrow a $200,000 loan or mortgage, but you can't afford the payment because you don't have the ability, it doesn't matter if your credit's great. If you can't qualify, you can't make the payments, that's going to be a problem. And lenders do not want to loan you money to buy a home if you're not going to be able to pay it back. So obviously, they're going to look at your income. Now, there are different ways of looking at income, and we'll talk about those in future videos. But for this purpose, they're going to look at your overall income. Tied to your income, they're also going to look at your current debts and then the debt of the new home that you want to purchase. So they're going to look at all the income coming in. They're going to look at all your expenses going out and make sure that you have enough money to cover all of them, plus a cushion for unexpected expenses and other expenses that aren't tied to credit and so on. So the combination of that is called your debt to income ratio. And it's just like it sounds. They take all of your debts, divide it by your monthly income, and that determines a ratio. Now, typically the total debt to income ratio is not to exceed 50% of your gross monthly income. There are nuances where it's a cap of a smaller amount like 43%, but that general rule typically holds. If you're over 50%, you're probably going to have an issue. If you're right in the 50% or to 43% range, you might have an issue. And under 43, you should be okay depending on credit. Last, they're going to look at your assets. And your assets are, where is the money coming from down payment? Do you have a down payment? How much is it? And also, what do you have left over after closing and using up your down payment? In other words, your reserves. So if you have 3 months left in the bank account after closing, that's better than 0 months of payments left in the bank account after closing, and so on. So your income, your assets, and your credit. Now, the final thing they're going to look at that's not really tied to you, but it's part of the underwriting process and the approval process, is the property itself. So here again, when you're putting, say, a 5% down payment down on a property, they want to make sure that you're buying the property at the right price. So you actually have 5% equity in the property on day one. And that limits their risk because they're lending at 95% of the property. In other words, the loan amount, there's still 5% equity at the day of closing when they close on the mortgage and give you all the money, as long as that property price is validated. And that is validated through an appraisal. And part of the appraisal that the lender requires is an inspection portion, which also verifies that the home is not in non-sellable format. In other words, if you could buy a home that is selling way below market because it needs 20, 30, 50,000 or some unknown amount for repairs. The lenders aren't typically involved in that. They want a home that's sellable. So there are specialty loan programs that you can buy the home plus get some money set aside from the loan program based on the future repaired value. That's a whole nother category, but I'm just talking about your standard mortgage here in this short video. So we've covered the property value and property inspection. So basically the appraisal that's going to determine if the property meets the standards, talk about your income, your credit, your assets. Those are basically the four main things that a lender is going to look at. It's pretty universal. And if you want to deeper dive into the details, go ahead and check the link below in the description or in the comments, or if I put it right here on screen. But I'll have a deeper dive video for you posted there as well. Thanks for watching.